Well, let's shift gears and check on the current state of the fixed income and interest rate environment with Jon Finkler. Jon, what's changed since you gave the November strategy update on fixed income, and what's the team focused on going forward?
Yeah, thanks, Brian. Well, the fixed income market has faced a fair amount of volatility recently, driven by a long list of factors, from unpredictable policy decisions to tariff uncertainty to ongoing geopolitical tensions and the Moody's downgrade of U.S. debt. And while some of these pressures have begun to ease, trade negotiations remain front and center, and increasingly, attention is shifting to the Federal Reserve and interest rate policy. Now, this backdrop has pushed short-term yields lower over the past quarter as markets increasingly expect the Federal Reserve to begin lowering its policy rate. Now, at the same time, longer-term yields moved higher due to concerns about future inflation and the growing U.S. debt and deficit. And we'll touch more on the debt picture here in a second. Now, on the screen, we're showing the U.S. Treasury yield curve at 2 points in time. The green line is as of March 31st, and the blue line is as of June 30th, to really highlight how these dynamics have played out. Now, as a quick refresher for those less familiar, the yield curve shows the interest rates or yields the U.S. government pays to borrow money across different time horizons, from a few months to 30 years. Typically, longer-term bonds carry higher yields than shorter-term ones, reflecting the added risk of lending money over a longer period. So let's consider what's shaping the Fed's thinking around when to start cutting rates, mainly their focus on jobs and inflation. The unemployment rate sits at 4.1%, which on its own does not signal imminent recession. But under the surface, there are signs of softening in the labor market. Now, for the Fed to act aggressively from here, we'd likely need to see more definitive signs of labor market weakness through spillover to the headline unemployment rate. Now, on inflation, the picture is still evolving. The Fed is taking a wait-and-see approach when it comes to whether tariffs will meaningfully push prices higher. Thus far, CPI data suggests tariffs haven't moved inflation significantly, which is encouraging, but that does not rule out future pressure. So the Fed is really balancing the data in hand with future uncertainty. And when this happens, the best thing to do is to be patient with adjusting policy until the unknown becomes known. So given the current dynamics, we're being very selective about where we add interest rate exposure, and we're mindful of stretched valuations in parts of the market. Now, in this environment, we believe active management is key, as passive strategies may leave portfolios overexposed to duration or credit risks without sufficient compensation. Now, I mentioned longer-term yields being concerned with potential inflation and the U.S. debt and deficit. With the latest budget and tax package from the administration, renewed attention has been placed on the size and trajectory of the U.S. debt and deficit. Now, as a fixed income investor, a rising deficit means the government needs to borrow more money, which it does by issuing Treasury securities. Now, when Treasury supply outpaces demand, the government may need to offer higher interest rates to attract buyers. And that's the dynamic we're seeing in the Treasury market, with longer-term yields moving higher, even as the Fed signals its intent to move short rates lower soon. Right now, the U.S. carries about $36 trillion in total debt, and the annual interest expense is approaching $800 billion. And while the White House claims the bill will reduce the deficit through increased growth and spending cuts, the Congressional Budget Office estimates the bill will add about $3 trillion to the deficit over the next decade. Now, as you can see on this graph, that would bring the deficit as a percentage of GDP to about 7%. There are still many unknowns as well. Specifically, if these tariffs remain in place, the revenues produced could help offset some of the costs of the bill. We've already seen a substantial rise in tariff revenues in recent months, an increase of over 100% year to date compared to the same period in 2024. But the new spending package as we know it has the potential to magnify already elevated borrowing needs and pressure the Treasury market, contributing to higher yields. Now, these higher yields in turn will keep the interest costs elevated, straining the federal budget and limiting future policy flexibility. It's a vicious cycle that we discussed during last fall's strategy update. And the recent downgrade of U.S. debt from Moody's, the last of the three major rating agencies to downgrade below AAA, reinforces this long-term risks. This is following years of unchecked spending, money printing, even outside of crisis periods. Now, while government support was vital during the Great Recession and COVID, these ongoing deficits are becoming harder to justify. So this is a dynamic we continue to watch, particularly as it relates to fixed income strategy. The high debt levels and potentially increasing deficit could push long-term interest rates higher, so we're favoring the short to intermediate end of the curve while keeping our overall duration closely aligned with our benchmarks. Now, even though yields have eased from their recent highs, we continue to see a strong case for fixed income in portfolios. Bonds not only offer a reliable source of income, but they also serve as a stabilizing force in portfolios, especially during periods of equity market volatility. Now, on the screen, we've graphed yields across several key fixed income sectors relative to their 10-year medians and historical ranges, focusing on the 1 to 10-year maturity spectrum. Now, this is by no means an exhaustive look at the bond market, but it does reflect the sectors we focus on most in our strategies. Now, what stands out is that today's yield environment offers a favorable entry point across many of these areas. Core sectors like treasuries, investment-grade corporates, municipals, and agency mortgages are offering yields not seen in over a decade, presenting attractive opportunities without taking on excess risk. Now, high yield still offers elevated income, but with greater credit and market volatility. So all in all, Brian, we think today's yield landscape presents a nice opportunity for income-oriented investors to lock in attractive yields across a range of high-quality sectors.